You have been told the Federal Reserve sets your interest rates. That is not the whole story. Your mortgage, your car payment, and your retirement account are all connected to oil-producing nations on the other side of the planet. The American economy rests on an arrangement most people were never told about. None of this is classified. Most of it is sitting in public records. Almost none of it was ever explained to you directly. Chapter 1. The Spring 2026. Rate Surge. In the final days of March 2026, the average 30-year mortgage rate climbed 13 basis points in a single week, the largest weekly move in nearly a year. A few weeks later, it surged again, this time by 34 basis points, pushing rates to their highest level since September 2025. Mortgage applications dropped 10.5% that same week. Refinancing collapsed. The cause was not what most people would expect. The Federal Reserve had not touched its benchmark rate. No inflation report had come in hot. What moved rates was military tension on the far side of the globe, pushing Treasury yields upward, and mortgage rates were pulled along with them. So how does a conflict thousands of miles away change what an American family pays to buy a house? Behind the numbers sits a small group of foreign governments holding enormous quantities of U.S. government debt. When one of them suddenly needs cash, the most direct path is to sell treasuries. When a major holder begins selling into an already unsettled market, treasury prices fall and yields rise. American mortgage rates are constructed on top of those yields. When long-term bond yields move up, 30-year mortgage rates typically follow. Banks price home loans off those bonds and add their own margin above. None of this is a secret. It is simply never explained in plain terms. The scale involved is larger than most people appreciate. Research from the Federal Reserve Bank of Kansas City estimated that roughly $141 billion in foreign treasury selling in a single month could push U.S. yields up by around 57 basis points. Other estimates run between 25 and 100 basis points depending on market conditions. A separate analysis published in the Journal of International Economics put the impact of a $100 billion sale at approximately 100 basis points within a month. Run that against the median American home purchase today. A 50 basis point jump adds roughly $130 to the monthly mortgage payment. Every month for 30 years, a 100 basis point move roughly doubles that figure, above $260 per month. Across the life of the loan, that accumulates to tens of thousands of dollars, all of it drawn from one family's financial future. The damage does not stop at the monthly payment. Home equity is the largest store of wealth most middle-class households ever accumulate. When rates shift sharply, that equity starts to erode. The home stops appreciating while the cost of owning it rises. That is wealth shrinking in slow motion. Higher rates also freeze new construction and renovation projects. Framing crews, electricians, and contractors lose work. That slowdown does not stay inside the housing sector. It spreads outward into car loans, student debt refinancing, and small business credit lines in communities that have no direct connection to global bond markets. All from a single movement in a distant market. One capable of sending tremors through the entire system before most people register that anything has shifted. Chapter 2. The World's Largest Pawn Operation. The Federal Reserve operates a mechanism called the FEMA Repo Facility. FEMA stands for Foreign and International Monetary Authorities. The mechanics are straightforward. A foreign central bank holds U.S. treasuries and suddenly needs dollars. It brings those bonds to the Fed as collateral, receives cash, and reclaims the bonds when the arrangement reverses. A short-term exchange, clean on paper. In practice, it is a pawn shop for entire nations. It was never designed as a permanent structure. The Fed launched a temporary FEMA repo facility on March 30, 2020 during the pandemic. The stated plan was to run it for at least 6 months. It was extended, and then extended again. On July 28, 2021, the Fed converted it into a standing facility with no expiration date. There was no public debate, no formal vote. It simply became part of the architecture. The pricing was set intentionally above market rates, 25 basis points above the interest rate on excess reserves. That premium exists by design. When conditions are calm, the private market is cheaper and easier to access. No one uses the Fed's counter when things are working normally. The facility only becomes attractive when selling treasuries into the open market would be more damaging than paying the Fed's markup. In other words, it only gets used when every other option is worse. The tension this creates is worth naming plainly. For years, the Fed has been tightening credit conditions for American households and businesses, making borrowing harder and more expensive. Simultaneously, it has been maintaining a standing facility that provides dollar liquidity to foreign central banks on demand. One policy squeezes the domestic borrower. The other ensures that if a major foreign holder encounters stress, a backstop is already in place. Critics describe this as a structural distortion. When the largest participants in any market know a safety net exists, pricing reflects that assumption rather than actual risk. Price discovery, which is how markets determine what things are genuinely worth, stops functioning honestly. And emergency tools, which are supposed to be rare interventions for unusual circumstances, start being treated as standard operating conditions. That is the shift. Rare becomes routine. The exception becomes the expectation. The FEMA facility became necessary partly because the traditional buyers of US debt had grown less reliable. The warning that the system was changing arrived years earlier. Almost no one was paying attention. Chapter 3. The signal everyone ignored. On September 17, 2019, the overnight repo rate, the rate banks paid to borrow cash against government bonds for a single night, spiked without warning. It moved from roughly 2.4% to above 5% in a single session. At one point, it briefly touched double digits. For a market that rarely moves 20 basis points in a day, that registered as a serious malfunction. The cause was mundane. Corporate tax payments drained cash out of the system at the same moment a large Treasury settlement pulled additional liquidity away. Approximately $120 billion disappeared from available reserves in a single day. The institutions that normally smooth these gaps chose not to step in quickly enough. Not because they were in financial difficulty, but because the regulatory incentives introduced after 2008 made them more cautious about deploying their balance sheets in stressed conditions. The New York Fed responded within hours. It injected $75 billion and repeated the operation each day for the remainder of the week. What the episode exposed was a system with insufficient buffer. Cash drained out through entirely predictable channels, normal tax payments, and routine Treasury settlements, and the system could not absorb it without Fed intervention. No one in a position of authority could say with confidence where the safe level of reserves actually sat. 2 years later, in July 2021, the Fed responded by making its emergency interventions permanent. The Standing Repo Facility for U.S. banks and the FEMA Repo Facility for foreign central banks were both created on the same day. One domestic, one global, both built to prevent 2019 from happening again. In preventing that specific failure, the Fed locked in a new assumption that central bank support would always be available when private markets pulled back. That assumption became the foundation for everything that followed. Chapter 4. Japan changes direction. For an extended period, Japanese financial institutions were among the most consistent buyers of American government debt, reliable enough that the market treated their participation as background noise. The mechanism driving Japanese money across the Pacific was the yen carry trade. Japanese interest rates sat near zero for years. Investors could borrow yen at minimal cost, convert it into dollars, and purchase higher-yielding American assets. The interest rate differential became the profit margin. Enormous amounts of capital flowed through that single structure. The movement was so consistent it stopped appearing as movement at all. It functioned as an invisible stabilizer beneath the Treasury market. That changed in 2025. The Bank of Japan began stepping back from its long era of near-zero rates. It raised its policy rate in increments, moving it off the floor for the first time in years. As Japanese rates climbed, the mathematics of the carry trade deteriorated. The cost of borrowing yen rose, while the rate advantage of holding dollar assets narrowed. For institutional investors who had built positions around that differential, the trade that had run profitably for years began to unwind. Japanese life insurers, pension funds, and banks started pulling back from U.S. Treasuries, not as a dramatic sell-off, but as a gradual reduction in demand. Holdings that had grown for years began shrinking. The stabilizing flow that markets had depended on started to slow. This matters beyond Japan. It represents a structural reduction in demand for U.S. debt from one of its largest and most consistent foreign buyers. The question it raises is straightforward. If that demand does not return, who absorbs the supply? Chapter 5. The Commercial Real Estate Pressure. American commercial real estate absorbed a sustained hit when remote work patterns shifted in 2020 and never fully reversed. Office occupancy in major cities stayed depressed for years after the pandemic. Buildings that once ran at high capacity sat partially empty. The owners of those buildings were carrying loans typically structured over 5 to 10 years and requiring refinancing when they come due. In a low-rate environment, rolling those loans over presented no particular difficulty. In a high-rate environment, the arithmetic changes completely. A building appraised at a certain value when rates were low carries a different number when borrowing costs double. The income it generates may not support the new loan terms. The owner faces a choice between injecting additional capital, renegotiating with lenders, or defaulting. Regional and community banks hold substantial portions of this exposure. These institutions funded the construction and purchase of commercial properties across the country. As those loans reach maturity and refinancing terms tighten, the stress becomes visible in bank balance sheets. The challenge for regulators is that the losses often do not surface immediately. Banks have tools to extend problem loans, modify payment terms, and keep technically delinquent borrowers from formally defaulting. That process buys time. It does not eliminate the underlying loss. The impairment accumulates quietly. The system continues functioning normally on the surface while the pressure builds underneath. When that pressure eventually forces recognition, it tends to arrive in concentrated doses. Several loans reach the limit of extension simultaneously. Several banks report losses in the same quarter. Credit availability tightens across the sector at the same moment businesses and property owners need it most. Domestic stress and global liquidity pressure begin pushing against each other from opposite directions. Chapter 6. The Dollar Squeeze in the Gulf. The Gulf region runs on a continuous supply of American dollars. Oil is priced in dollars, export revenue returns in dollars, sovereign wealth funds are denominated in dollars. When the Iran conflict escalated in late February 2026, its effects spread immediately through global commodity markets. The closure of the Strait of Hormuz restricted the flow of roughly a fifth of the world's oil supply. Prices rose, inflation expectations followed, Treasury yields and mortgage rates moved with them. As instability spread through the region, Gulf governments began drawing more heavily on dollar liquidity. These countries are typically described as the wealthy side of the equation, the buyers of skyscrapers, sports franchises, and corporate stakes around the world. But when dollar funding tightens, even they feel the pressure. The countries people imagine as financially self-sufficient still depend on the same Federal Reserve mechanisms as everyone else. When conditions tighten, they need dollar access quickly. The image of total independence holds only while dollar liquidity is plentiful. When the funding environment tightens, foreign banks face a specific set of options. Selling treasuries directly into a stressed market solves the immediate liquidity problem while making it worse. Dumping bonds pushes prices down and yields up, which means the value of the remaining holdings also falls. The institution resolves one problem by damaging its own balance sheet in the process. Most institutions prefer to avoid that outcome unless forced, so they use the Fed's facilities instead. They borrow dollars, post collateral, and avoid introducing large treasury sales into an already stretched market. That decision has consequences for American households. If enough treasuries hit the market simultaneously, yields rise, mortgage rates follow, retirement portfolios take hits. A liquidity decision made in a Gulf finance ministry can change the monthly payment on a house in Ohio or Tennessee. The backstops exist to interrupt that chain reaction. Without them, forced selling could spiral quickly, driving yields sharply higher and destabilizing everything built on top of them. These arrangements are technically structured to protect the Fed from direct currency losses. They are not simple bailouts in the conventional sense, but the repeated use of emergency mechanisms transforms them into something else. What was designed as occasional crisis response becomes structural dependency. The system prices the backstop in as a permanent feature, and the permanent feature becomes harder to remove. Chapter 7. Who actually holds the debt? The popular image of a foreign creditor threatening to dump treasuries unless demands are met is largely fiction. When swap line discussions occur, they are not ultimatums. They are contingency arrangements. Countries holding large reserves want confidence that if markets freeze or dollar access tightens, liquidity will still be available. Kuwait's U.S. Treasury holdings have climbed to record levels near $66 billion. UAE holdings are in the tens of billions and growing, backed by reserves considerably larger. These are not distressed borrowers seeking rescue. They are large creditors seeking stability assurances. The real purpose of these arrangements is not to preserve the creditor. It is to stabilize the treasury market itself. The danger is not that a large holder loses money. The danger is that a large holder becomes a forced seller in a market already under stress. The word precautionary is carrying considerable weight in how these facilities are described. Less emergency aid, more management of creditor behavior, which places the United States in an uncomfortable structural position. If policymakers fail to reassure major holders, the risk of panic selling rises. If policymakers build permanent reassurance mechanisms, the dependence becomes structural. The issuer of the reserve currency begins managing the conditions under which its creditors remain comfortable financing it. Neither path resolves cleanly. And once one major holder grows cautious, others notice. That is how behavior spreads through financial markets. If one large participant starts hedging, every other large participant starts asking whether they should as well. The stakes are elevated because of what the treasury market represents. U.S. government debt has functioned for generations as the foundational safe asset in global finance, the instrument underneath everything else, but the composition of who holds that debt has changed. In 2024, foreign private investors overtook foreign governments as the largest overseas holders of U.S. treasuries. And private capital operates according to different rules. These are not central banks holding debt for strategic reserve management or geopolitical alignment. They are asset managers, hedge funds, and leveraged traders running complex positions through global financial networks. Their mandate is to move when conditions change. The Treasury market replaced part of its most stable demand base with something considerably more reactive. Chapter 8. The Standing Backstop. The Federal Reserve has taken on a function it was not originally designed to serve. It now operates as a standing source of dollar liquidity not only for American banks but for the global financial system, foreign central banks included. Reasonable people disagree about whether that expanded role represents responsible crisis management or a form of institutional overreach. The disagreement is legitimate. What is not in dispute is that the expansion has occurred and most people outside financial markets are unaware of how far it has gone. The Fed's total interventions to stabilize the financial system since 2008 have exceeded $29 trillion, enough to eliminate the vast majority of the national debt in a single transaction. Not $1 of that built a road, funded a classroom, or increased the productive capacity of the economy. The purpose was narrower: prevent a system carrying deep structural problems from having to confront them. Every dollar bought time. None of it purchased a solution. What has diminished through all of this is not money but independence. American prosperity was once nearly self-financing because global demand for U.S. debt was organic and sustained. That condition has weakened. More creditors now require official backstop assurances as a precondition for staying in the market, not as an unusual accommodation, but as something assumed to be available whenever selling pressure emerges. At the same time, the holder base has grown faster moving and more sensitive to rate and liquidity shifts. That combination makes it harder for private demand alone to absorb stress when it appears. The Fed's backstop is no longer temporary. It is no longer small. The system now depends on two things that cannot be taken for granted: the continued willingness of major holders to keep holding U.S. debt and the standing presence of central bank support for the moments when they consider otherwise. That is not a forecast of collapse. It is a description of conditions already embedded in the system. Conditions like that do not remain theoretical indefinitely. But assume the worst does materialize. How would the average American navigate a dollar that no longer holds its value? And who ends up absorbing the damage?